Billionaires lose millions on purpose. And they get richer doing it. This is the strategic bankruptcy playbook they use to eliminate debt while keeping every dollar of their real wealth completely untouchable. Here is what nobody tells you about wealthy business owners. When their companies fail, they do not lose sleep. They lose debt. The game is rigged from the start, but not in the way you think. Every sophisticated investor structures their holdings so that business failure becomes a feature, not a bug. Think about that. They build their empires on a foundation designed to let pieces fall without bringing down the whole structure. The mansion stays. The investment portfolio stays. The retirement accounts stay. But the business debt? Gone. Discharged. Eliminated. And here is the part that will blow your mind. This is not tax evasion. This is not fraud. This is completely legal strategy that has been refined over centuries of corporate law. But the question you should be asking is not whether this is legal. The question is why nobody ever taught you how it works. Let me break down the basic structure, because once you see it, you cannot unsee it. The wealthy do not own their businesses directly. They own holding companies that own operating companies. Picture it like Russian nesting dolls. At the very center is the risky operating business, the one that deals with customers, takes on debt, faces lawsuits. That entity is designed to be expendable. Wrapped around it is a holding company, completely separate legal entity, that owns the valuable assets. Real estate. Intellectual property. Equipment. Cash reserves. These assets get leased back to the operating company. So when the operating company fails, the holding company simply takes back its assets and leases them to a new venture. The debt stays with the dead company. The assets flow to the next opportunity. If this sounds complicated, that is intentional. Complexity is the moat that keeps average people out. But here is where it gets interesting. The timing matters more than anything else. You cannot just create these structures when things go bad. Courts call that fraudulent conveyance, and they will pierce through your entire setup like tissue paper. The wealthy set this up years before any trouble appears. That is the real secret. Asset protection is not a crisis response. It is a foundation you build when the sun is shining. Think about it from a judge's perspective. If you transfer your house to a trust the week before getting sued, that looks like fraud. If you transferred it 5 years ago as part of a normal estate plan, that is just smart financial planning. The wealthy understand that protection must be built proactively. They are playing chess while everyone else is reacting to checkers' moves. And this brings us to something most people completely miss about strategic bankruptcy. There are 3 types of bankruptcy in the United States, and the wealthy use them very differently than everyone else. Chapter 7 is liquidation, typically for people with no other options. Chapter 13 is reorganization for individuals. But Chapter 11, that is where the magic happens for business owners. Under Chapter 11, a company can discharge massive amounts of debt while continuing to operate. The key word is company. Not you personally. When a business files Chapter 11, the owner's personal assets remain completely untouched if the structure was done correctly. The business negotiates with creditors, often paying pennies on the dollar, while the entrepreneur walks away to start fresh. Banks know this game. Vendors know this game. That is why they charge higher interest rates to small businesses. They are pricing in the probability that the owner might use these exact strategies. The system anticipates this behavior. But here is what blows the whole thing wide open. And this is something even sophisticated investors miss. The real wealth preservation does not happen in bankruptcy court. It happens years earlier through something called equity stripping. Here is how it works. You take a property worth $1 million. You take out loans against it, secured by the property, for $900,000. But those loans come from your own holding company. On paper, you have almost no equity in that property. A creditor suing you sees a property with $900,000 in debt and thinks it is worthless to pursue. But that $900,000 is sitting safely in your holding company. You have moved the value without moving the asset. The property still generates income for you. The debt creates a barrier against lawsuits. And here is the darkest part of this whole system that nobody wants to talk about. The people who can afford to implement these strategies are already wealthy. That is the brutal truth. Setting up proper holding company structures costs $15,000 to $50,000 in legal fees. Maintaining them requires annual accounting, registered agents, and compliance costs. Poor people cannot afford the structures that protect wealth. Rich people cannot afford not to have them. This creates a compounding advantage that gets wider every single year. When a wealthy family has a business failure, they pivot. When a middle-class family has the same failure, they lose their house. Same legal system. Same bankruptcy courts. Completely different outcomes based entirely on preparation and structure. And the banks, they know exactly who has protection and who does not. They market aggressive loans to people without structure, knowing they can chase personal assets. The game is visible if you know where to look. So what can you actually do with this information? Let me give you the practical breakdown. First, understand that limited liability companies are your starting point. An LLC creates legal separation between you and your business at a fraction of the cost of complex structures. For under $500 in most states, you can establish basic protection. Second, never personally guarantee business debt unless absolutely necessary. Every time you sign a personal guarantee, you punch a hole through your corporate shield. Third, build your structure before you need it. The 5-year look-back period for fraudulent conveyance means your protection gets stronger every year you wait. Fourth, consider umbrella insurance as a poor man's asset protection.